incoming massive market volatility with US elections this week. How is the dollar going to react? Guys, Ken Chigbo back with another E8 market fundamental update. Let's jump straight into this. Guys, before we break down this week's key events, let me address the elephant in the room. I do have a big black eye here, and it's not me having a punch up with the markets or with anybody. It's me playing football or soccer, as you call it in America. Soccer on the weekend on Saturday. I took a bit of a knock to the eye, but it doesn't stop the energy and how ready we are to tackle this week, excuse the pun. So we do have US elections and on Tuesday, November 5th. And what are markets expecting? Well, it is a very, very close presidential race, okay, between Kamala Harris in the Democrats and Donald Trump in the Republicans. And Donald Trump is actually seen, if we've been speaking about the Trump trade within recent weeks and how that's been one of the supporting factors. You know how we have a number of supporting factors, which we're going to take a look at the dollar in a moment, a number of supporting factors for the dollar. One of those has been the Trump trade, and Trump is seen as potentially his policies that he's going to implement seen as more inflationary, right? And we're going to talk about why that benefits the dollar, but seen as inflationary because a couple of things. One, he's looking at potential tax cuts. Okay, if we're cutting people's taxes, what do you think they're going to do with all this extra cash, right? Or they're not paying taxes on. They're going to spend, stimulate the economy. And then, of course, that's inflationary. And then potential tariffs. You know how we had the Trump, the trade wars anyway with China and the US. Potentially is going to come in, more tariffs. And obviously, at the end of the day, this is going to cost companies more if they're having to pay tariffs, all that. And then they're going to pass that cost on to consumer. Their goods and services costs are going to go up, right, with these tariffs. So that's, again, inflationary. So with that in mind, Mark is then thinking, could this slow the FOMC down from this current rate cutting cycle? Because the FOMC won't want to keep cutting fast and consistently if we're battling with Trump's policies that are also inflationary. Because remember, when we're cutting rates, we're lowering borrowing costs for people, and then people are going to start spending more money, and we're going to have inflation overshooting again. And the FOMC doesn't want that. So they're going to have to take this in consideration depending on the result on Tuesday. Now, look, as I say, the dollar would like to, I mean, it's expecting a Trump outcome. I think we'd still get a relief rally for the dollar, especially when markets think about what I just said about the pushing the FOMC back with rate cuts. If we look at the dollar here, obviously we've been massively expecting dollar to carry on with the upside. This is 1, 2, 3, 4, and just about 5th consecutive session in the green there. It's broadly a flat week. Again, just a little bit of positioning, a little bit of caution heading into obviously this big week with the elections and of course with the FOMC rate decision. But I think the election somewhat overshadows that because dependent on the elections, dependent what the FOMC then do, which we'll talk about in a moment. But remember, all these supporting factors to the upside of the dollar has been, you know, geopolitical tensions, Israel, the Middle East. We've got obviously the Trump trade. We've had solid economic data. We've got sticky inflation in the United States. There's a number of factors that are supporting the greenback to the upside. When you look obviously on the monthly as well, look at that. Look at that incredible bullish engulfing candlestick there. We'd set up for a reversal there in September with a potential morning star, validated with that, with some buying there coming into play in the month of October. And we left this week, which we're already going to fill. We're pushing for a fill of that to the upside. Now, interestingly, if you look on the daily, okay, if you look on a daily here, couple of things. One interesting thing is that we've got this potential inverse head and shoulders. You got the left shoulder there, you got the head, and you got this right shoulder potentially forming. And when you look at this as well, we could potentially view this as a bullish flag, like which we're trying to break out of. We'll keep an eye on that neckline around that 104.50 area. And obviously, if we do get a scenario where we get a win for Trump, there's no reason as to why we can't get a breakout of this heavy area of supply. Little retest, perhaps use it as new support, because obviously this is clearly supply there. And then we can have room to run in towards quite quickly, well into 105 territory, the mid 105 area, 105.50. Now, focus this week, of course, after the elections will be on the FOMC. Now, the FOMC is priced in, if you look at the CME, the Fed's watch tool, CME watch tool, the large probability is a cut of 25 basis points, as you can see here. So if they do cut by 25 basis points, they expect the dollar to strengthen. Okay, but there's a case, right, because it's priced in. And guys, we look at data, it still doesn't warrant them cutting, you know, so it's largely priced in, and I don't think they're going to leave. I think they're going to really emphasize that this is gradual, that moving forwards, don't start pricing in, getting ahead of yourselves and pricing in rate cut after rate cut after rate cut. consistently, it's going to be gradual. I think they'll really need to emphasize that because inflation's still sticky in the US. And then, of course, potential, depending on this outcome with the elections, if it's a Trump victory, again, they're going to want to hold fire. I wouldn't be surprised if, you never know, they could not cut by 25 and then dollar strengthens. Okay, then dollar really rallies. And then obviously stocks could come under pressure. So, yeah, some further potential upside pressure this week with these key events. But you need to really have your finger on the pulse this week, guys, with the dollar. Expect plenty of volatility with GBP because we also have the central bank decision, the Bank of England rate decision, where they are expected to cut by 25 basis points on Thursday, taking the rate down to 4.75% from 5%. Now, that is expected. The reason being, if you look here, guys, GBP, if we look at CPI, the most recent CPI reading, we go to that on that day, you'd see inflation cooled across the board in the UK, dropping down to 1.7% there on the year on year, the core dropping down to 3.2%. So inflation's drastically coming down in the United Kingdom, which is why we should expect some rate cuts from the BOE. Now, it depends on how close of a call is this decision going to be. Is it going to be a unanimous one where all members are voting for a cut? Or is it going to be quite split? Because if it's quite split, that could be GP positive. But I think regardless of that, the door will be left open for more action, especially how inflation's coming down in the UK. And we are generally seeing a cooling in the United Kingdom economy, UK economy. So I expect GP to remain vulnerable. On the monthly here, obviously, that screams vulnerability anyway. After that big bearish engulfing candlestick there in October, we've left the room for further downside. And you can see this trend line has been supporting the price since sort of mid-2024. You can see that very valid trend line there, supporting the price to the upside, but clear, made way for a clear potential break there, as you saw on Thursday with that downside pressure for the pound. And the pressure for the downside came with UK policies, how we've got this, there's going to be fiscal spending. And it's seen as a bit of a GP negative because it could throw off the Bank of England at the moment. Because it could prove to be inflationary and it could throw off the Bank of England from their current rate cutting cycle. And note that the UK doesn't want a situation where we get stagflation, where inflation creeps up again and growth is low, which we're seeing at the moment in the UK. Growth is low. They don't want a situation of stagflation. The Bank of England, the UK economy needs those rate cuts. So that's why there's some vulnerabilities there. And we had this volatility to the downside for the UK, for GP. But when you look at it structurally, we are still very much to the south. See those lower highs and lower lows, respecting that structure, and I still see that resuming to the downside. You see how we break out of these consolidation patterns? Yeah, I'd like to see that just resuming to the downside, going pretty new lower low, perhaps in towards 128. When you look on a higher time frame, as I said, sorry, guys, speaking another language there. When you look at a higher time frame, you can see that vulnerability. And I've said it to you guys before, I'm very much interested and see this heading all the way down in towards 26 territory, maybe just sub 27. See how we deal with this area here that we were last at in August. So yeah, keep an eye on that Bank of England rate decision. Another central bank decision for Australia. So expect some volatility for the Aussie dollar, where the RBA are not expected to change policy. You know how obviously other major central banks are in this rate cutting cycle. The RBA haven't started theirs yet because, two things. One, the labour market's been relatively solid. Two, inflation's remained sticky or has been. That's why they've been keeping rates unchanged, and they've been previously speaking about potentially hiking rates. Now, if you look here a minute, guys, I just want to show you. Inflation in Australia has come down. So let's just pull it up here. You'll see Aussie CPI. Look at inflation here across the board. We had the reading at the end of last month, at the end of October, and you see inflation's come down quite substantially there to 2.1% from 2.7, quarter on quarter coming down to 0.2%. So drastic cooling in the CPI readings, which I think could now stop the RBA from being hawkish. You know how they've been hawkish, speaking about potential rate hikes because inflation remains sticky. I think that will be removed from their statement now. No talk of hikes, and it'll be more neutral. Okay, them getting closer, a step towards rate cuts, which I believe could provide some vulnerability, some opportunities for downside pressure for AUD. Same sort of thing with AUD versus its peers. In comparison to its peers, big bearish engulfing candlestick there in the month of October. And similar to GU, really, how we've had this trend line supporting the price to the upside. We're just at that trend line at the moment. It's big demand basically around this sort of mid 65 region, looking for that to be broken down. Structure is very strong to the south. And look, on a 4 hour here, we've got a potential narrowing pennant flag, whatever you want to call it, but subject to resumption, another wave of downside pressure, and to break that out. I'd like to see how we deal with this zone here. There's definitely a valid zone here protecting sort of 65.50. If we're able to take this out, this should open the door for further selling, and there's no reason why this can't trend to the downside, especially if we've got that Trump victory in the elections, especially if we get the RBA moving to a more neutral stance. There's every reason for this to continue to the downside. So once again, guys, we are blessed with market volatility. It's so important that you got your finger on the pulse with these macros, because macros are driving the market. Other than that, have an amazing and blessed week, and I'll catch you on the next video.